Good afternoon, everyone. My name's Ben Walters. I'm Deputy Treasurer at Kpis Group. I'd like to thank you all very much for choosing this session in which I aim to talk about a couple of scenarios and issues that cropped up within Kpis following a recent upgrade to our treasury policies. So I'm going to talk about FX risk management. I'm going to touch on two areas within that, just to give you an idea of a couple of the problems that we had to face and how we went about overcoming those. So just skipping into a little bit of an introduction here. Kpis is a listed multinational business, and we operate across about 45 countries. So there's a lot of different currencies involved in the group's makeup. We undertook an exercise about 2-3 years ago now to look at our treasury policies. And I was handed the task of looking at two particularly sort of challenging areas, which was our FX risk management policy and our interest rates risk management policy. And I guess I was given those because I'm one of these people that went through the whole ACT educational process. I have unfortunately a reputation for being fairly sort of technical in those areas, and therefore I was handed the baton on those two areas. I do have to admit at this point that this is something that I do hold a strong interest in, and I have developed through my own website actually some thinking around corporate finance theory in these areas to do with strategy, risk management, and capital allocation. And I would, if any of you do have an interest in that, then please look me up on that. Always happy to enter into discussion with people. So moving on to the first part of this case study. Big picture terms, we're looking now at our translation risk policy around FX. As I say, Kpis is a very big multinational listed group. Pre-pandemic revenues are there at about £24 billion. Now, we tend to focus on three external KPIs when we talk to the market. And obviously we've identified these as being strategically very important to telling people how a group's doing. Now the first of those is organic revenue growth. We believe that this is a sector with a lot of opportunity in it for disciplined growth. Obviously you can chase growth at any price, but I believe we do it in a very disciplined way. But that's an important metric for the market to see how we're actually developing the contract catering sector that we operate in. The second KPI, very important in contract catering, is margin. It's a high volume, relatively low margin business. So, the ability to demonstrate that we are making continual improvement in the margin is a key indicator of how efficiently we're running our organisation. Now the third one is a balance sheet KPI, and for us what's very important is we call it our leverage ratio. It's our net debt to EBITDA. Now, the reason why this is an important ratio for us is that we have a publicly stated policy to maintain strong investment grade credit ratings. We actually define the target leverage of, it's changed due to a pandemic, but about 1.5 times or slightly below that now. So we're saying that our net debt will not be greater than our EBITDA by around 1.5 times. And what that means is that, when we go through our planning processes and that sort of thing, we can look at our budgets and forecasts and say, well, we think EBITDA is going to be around there. And we can use this target that we have and we stick to very closely to say, these are the levels that we can spend money in areas such as M&A and capital, the ordinary dividend, and then if we find that there's surplus within the leverage ratio, then we can think about returning excess cash to shareholders. So it's a very important ratio for us in terms of credit ratings and shareholder return management. It demonstrates very good sort of balance sheet discipline to the market. So it's a key ratio to us. And therefore, when we were looking at how Treasury can contribute to the group's external messaging and the group's perception of success, it was really around how can our policies support any of these KPIs. But I think it's pretty obvious that it's that leverage ratio where the translational FX policy can really contribute to that. So basically, we started from a thought process that said, what can we do within our FX translation policy to support the balance sheet leverage ratio? Just going to click on a little bit in this one to bring up the information that this slide gives you. So we've got two components now of that leverage ratio. We've got EBITDA and we've got net debt. And I'm sure, as you all know, EBITDA is a P&L measure, and it's translated at the average exchange rate for the year. Net debt is translated at a point in time, so at your year end, wherever spot rates are. If you've got debt in different currencies, it will be translated at that spot rate. So seemingly, you've got a bit of a problem there. You've got a P&L based measure being translated at average rate. You've got a balance sheet net debt figure being translated at closing rate. Now, the epiphany here, which I'm not claiming any uniqueness for, by the way, but the realization that actually when you look at average exchange rates and compare them to a closing exchange rate at a point in time, so if you take an average over 12 months and you look at a closing rate 12 months into the future and do some very boring stuff, which as treasurers we will probably have had nightmares about in the past, but based around standard deviation, if I dare mention that word, and volatility, it roughly turns out that that average exchange rate is about 0.6 times as volatile as that closing rate. So what that's saying is that the average rate, and I think this is common sense, is less volatile than a closing rate. Perfect common sense. You're taking 12 points of exchange rate and averaging those out versus one rate at a point in time. Now, what that implies actually is if you want to level off the volatility between EBITDA and net debt, if you're looking at, say, holding, let's say in Kpis' case, around 55% of your EBITDA comes through in US dollars, you actually only need statistically 0.6 times of that in US dollar net debt to even out the volatility of the conversion of EBITDA of average rate and net debt at closing rate. So the bottom line is that you only need to hold 0.6 times of your dollar EBITDA debt. In our case, with EBITDA coming through at 55%, that means holding around 33% of your net debt as US dollars. And if you run the analysis and test that, what you will find is that the overall level of conversion, if you run it hundreds and hundreds of times, evens out. The obvious caveat is that at any given point in time, that closing rate can be very different from the average rate. But I think in terms of what can we do realistically to manage the risk to our leverage ratio. I think all we can do realistically is use the statistics. This is one occasion where, I would say that the statistics, in my opinion, are worth bringing to bear on this. Now, that was a long-winded explanation of where we got to technically with the policy. I'm sure, as many of you will have experienced, you can think of that actually as the easy bit. You've now got to try and explain this technical analysis to your CFO, ultimately to your board, so they can approve a policy. And as we all know, one of the challenging parts of our job is to distill complex pieces of analysis like this down into something fairly simple, but without losing enough detail for people to ask, probing questions around it. So that exercise is always a challenge, but it's a good one in many senses, because it forces you to think exactly what you're trying to get across. The other concerns were around, well, what do our other listed sort of peers do in the sort of FTSE 100? So there was a little bit of analysis around, a handful of peers and what sort of policy they seem to adopt around their translation effects policies and their policies around the currency with which they hold debt. All a little bit inconclusive in a sense, but useful to see that there seems to be a range of management policies adopted by our peers, and therefore what we were proposing fitted in well within a spectrum of what we saw other people doing. Now, we also at the same time asked a couple of our relationship banks we set them the same piece of homework. We said, look, here's our translation policy. We want it to support our balance sheet leverage KPI. Go away, do some homework, come back with an answer. Now, I'm very pleased to say that actually the conclusions that we received back from our banks were very similar to where we got to ourselves, and that was done in a semi-independent manner to make sure there was no sort of, we really were arriving at something that people agreed was a sensible policy. Now, the upshot of all of this was that we moved from what I would say, I think traditionally has been an approach that we've all been brought up with, which was to hold a level of debt in proportion to roughly the proportion of EBITDA or free cash flow generation. So going back to that 2 slides ago, we were holding sort of 55% of our debt in US dollars. What this analysis allowed us to say was that actually, statistically, holding 33% of our group net debt in US dollars is actually the lowest level of volatility that we can give to the leverage ratio. Now, that's a very important point here. We then said, but we don't really want to anchor ourselves to a specific target. So we looked at a range in which we could hold our currency of debt, pivoting off the EBITDA ratio for that currency. So for dollars at that 55% level, we gave ourselves a range which would allow us to hold debt a little bit above 55%, but also going down to that 33% that we had identified as being the best level of dollar debt to hold in order to smooth volatility over the next 12 months. Now, this was done a couple of years ago. Now, I'm sure you'll all remember that a couple of years ago, the US had embarked on a bit of a rate hiking cycle, whereas the rest of the world was still very much stuck in some very low interest rates. So the upshot was that not only were we able to de-risk our leverage ratio, but also by holding or by allowing ourselves a range in which we could hold lower dollar debts than we had done in the past, it meant that we were able to benefit the interest charge. Dollar interest rates being at about 2.5%, euros being negative, sterling being very, very low, sort of below 1%. So by holding less dollar debt, ultimately more sterling debt, there was a benefit there to the interest charge. So this is, I think we're all sort of brought up to think that there's no win-wins, but this actually, I think, genuinely was a win-win from our adoption of this policy. So that's the first area that I wanted to cover in this case study. The second area is really about something that, well, I call it the currency map, but it's aimed at identifying FX exposures within the group, and it does overlap to a very large extent with what I've just been talking about. But I think there's a specific tool here which is very relevant to businesses that operate in different currencies, but also within their subsidiaries have further exposure to different currencies. Because what a currency map is all about is it's drawing out the underlying currency within which the group transacts and cutting through whether or not that's coming through a subsidiary which reports in dollars or reports in euros. Now, I think as we're all probably well aware, this is a very challenging area sometimes in a big group with lots of subsidiaries to actually identify the true exposures. I think it's an important area where, if you have that type of business, then it's a really useful tool for actually seeing exactly what your exposures are. And a point that arose out of a pandemic here, if I just look at the 2 bullet points at the bottom of this slide, is that ordinarily you'd think of this as a P&L type exposure. But actually what the pandemic brought home here was that particularly when you're facing a lot of uncertainty around your cash flow, your level of cash generation, where your business is very, seriously impacted, then actually being able to identify where your currency, your underlying currencies within your group are impacted, and compare that to the currency with which your headroom is denominated in. So I'm talking about, say, your revolving credit facilities, your committed bank debt, which ordinarily you wouldn't really want to be drawing on. It's there as your backstop. But if that facility is a sterling facility, but a lot of your business is coming through in dollars and euros, then, and things are perhaps looking a little bit tighter than normal in terms of headroom, the impact of exchange there can actually play a vital role in seeing, if exchange rates move a little bit, my dollar and my euro cash flows weaken even further because of exchange, as well as an impact on the business. Do my sterling facilities still provide me with enough headroom? So, an important point there actually, which isn't immediately obvious. Moving on to this slide. So this is a demonstration of a currency map, and I'd like to give some credit here to BNP, who have written what I would describe as a really, really useful book around, well, the title there is on the slide. It's Corporate Financial Risk Management. It's a very useful book in my opinion, because it actually brings in some new thinking, some new ideas, fresh from the banking side, but very much tailored towards common problems that we as treasurers face. I think it's an excellent, this particular section on currency mapping, I think, is an excellent piece of work by BNP. So what we're actually seeing in a currency map here is that, you've got subsidiaries which report in euros or dollars, or to the far right, you've got a Brazilian subsidiary, but actually within those businesses, the euro business has a big dollar cash flow exposure. One of its main suppliers is a US supplier. The US subsidiary has a Brazilian exposure there, because it takes a lot of its supply from a Brazilian supplier. This is a real life business, by the way, so it's not just being sort of created to try and demonstrate a point. Now, at this point, I guess some of you will be thinking, gosh, there's a slide with lots of numbers on, and you'd be right, but hopefully I can just make a couple of key points from this slide. If we just look at the top row here, the top section, this is a very simple example of a group that consists of just two subsidiaries. There's a US subsidiary and there's a sterling subsidiary. The US subsidiary is sitting there and contributing £46 million worth of profit to a group total profit of £67 million. Our sterling subsidiary is contributing £21 million worth of profit. So in a normal sort of accounting style consolidation, two subsidiaries, a dollar functional subsidiary creating 46 million of profit, the sterling subsidiary 21, group total 67. Fine. Our currency mapping though is we go out and we ask the US subsidiary, right, what is the underlying cash flows that you're transacting in? How does that add up to that 46 million of sterling equivalent dollars that we see you report to us? And the answer they come back with is actually our revenue, our net dollar cash flow, revenue less a few dollar costs, is 71 million pounds positive. But we're being supplied by a supplier, and that cost there is 25 million sterling. So that gets us to our 46, but actually our dollar figure and we have a sterling figure within that 46, which if you just look at the accounting consolidation isn't obvious. Our sterling subsidiary, very similar story, but the other way around. Profit of 21, but actually a very big sort of dollar input there in terms of costs. Now, you've probably at this point got two FDs from the two subsidiaries phoning you up saying, I've got this big currency exposure. And a traditional way of dealing with that would be to say, right, well, let's deal with your exposure in your dollar subsidiary and separately your exposure in your sterling subsidiary. Fine. The problem there is that by dealing with each exposure individually, you end up doing two things. You end up actually buying dollars in aggregate across the group, mainly because your sterling subsidiary has such a big dollar cost within it. Whereas if you look at the currency map of how you're generating your 67 million of profit, your currency map's telling you that actually only 17 million of that profit comes from net dollar cash flows, and the other 50 is sterling. So if you just hedge on a subsidiary by subsidiary level, you end up buying dollars, whereas a group, you want to be selling dollars. You also do another thing, and that is you enter into a total nominal value of hedging here of 79 million, whereas on just a purely currency map basis, which is telling you you've got 17 million of dollars there, all you need to do is enter into hedging derivatives that add up to 17 million. So there's two effects here, and I will admit at this point, I've created an example here which just show you two extremes, but I hope it illustrates the point that if you just look, just looking at things on that accounting basis can give you a very, very different answer and ultimate conclusion than actually looking at things on a currency map basis, which breaks down your consolidated profit, 67 million pounds in this case, into a dollar profit figure, a sterling profit figure. So just moving on there, I think this slide is really reiterating what I've just tried to explain on the previous one. The currency map gives you the true economic currency exposure. And if you if you don't use the currency map, if you look at just a subsidiary by subsidiary level of exposure and try and manage that, like I say, can lead to a situation where you're grossing up your hedging, and also it can give you overall a different result to what you actually need to be aiming for if your purpose is to manage the group's exposure to currency in its group P&L. Now, clearly, by managing on a subsidiary by subsidiary level, you're helping out those individual subsidiaries perhaps to take FX noise out of their own budget targets. But that's not beneficial to the group. And again, we go back to another area where FX hedging, FX risk management is a complicated process. There's different imperatives there coming up through the business and looking at things top down from a group. Just the last point on this slide, we then have a further area of complication in that the accounting rules can be a little bit unhelpful. Clearly a transactional exposure, if you've got outstanding receivables and payables, the P&L effect of that is direct. When we talk about translational FX hedging, if we go back to the first half of this presentation, very often we put that into a net investment hedge and we take the FX to reserves. So it's managing the accounting interaction here as well, so that you actually can get the benefit in either reserves or P&L, depends what your objectives are. So that's an example. There's some complexity, and a common rule, of course, as well, is that the tax charge tends to follow the P&L treatment. So again, on a subsidiary by subsidiary basis where tax is critical, you want to try and get the right result coming through in their P&L, balance that with the result that you'd like in your group's P&L. So just to summarize, FX is one of our most challenging areas. It combines a level of sort of technical skills, but also communication. There's a lot of misunderstanding when you get outside of treasury and your key finance people as to the effect of FX within a business. Without, and that's perfectly understandable. People have set budgets, they don't want FX to come along and ruin their budgets. Their priorities are different, very different to ours, and therefore communicating what we need, keeping things simple but effective at the same time is a key challenge there. So I think just a couple of points that I think came out of our overall exercise here, and we're still on this journey. I think the more you can automate, the more you can get into a reporting system, into a database, and move away from spreadsheets and Excel, the better. These things can be a very time-consuming exercise, and if you have to repeat it regularly, that automation, that getting it into a formalized reporting system can take so much work out of the process. And I think also as well, it allows things like much better scenario planning. It reduces point risk on key personnel. So, these are things that we should be thinking about all the time. Lastly, just to reiterate, currency map, can't sort of push it highly enough. Obviously, there's a payback here. I think if you've got a simpler group structure and there's not a lot of transactional FX going on, then fine, you can probably get away without a formal currency mapping process. But if you do have some complexity there, rolling out a currency map within a reporting system, almost, if you can, really can add some real value to our ability to see those exposures and to manage those in the best way. So I'm practically out of time. I don't know if there are any questions. My website is up there on the screen. How often do you reassess volatility? At Kpis, we do that every 6 months. I hope that answers that question. It doesn't tend to change a lot. The answer doesn't tend to change, but we do review and we do look at that level of overall currency in net debt every 6 months. What tools are you using for your automation? Well, we use a reporting system at the moment. We are trying to bring in a much more formalized scenario planning application. And I think I'm out of time there. Thank you for your questions. Thank you very much.